and it's not cherry picked. It's 100% understanding. And to answer some of the folks that were crowing to me, can you teach swing trading? Can you talk about higher time frames? I don't want to look at a 1 minute chart. I'm never going to trade a 1 minute chart. Okay, that's you. But that same idea of understanding what price does and how it delivers, what makes price book the way it does. You can study hundreds of examples over a course of a few months in 1 minute data. And that same logic being applied to a daily or weekly or monthly chart, it's still the same thing. It doesn't feel like that could be true, but it's exactly what it is. Because price, here's the major discovery that I had that was a major epiphany. I thought that the market was independently doing things, randomly all the time. When it's not. It's not doing that at all. It's working from higher time frame charts down to lower time frame charts. It's trading to where liquidity is resting, obvious below old low, below old equal lows, or above old high, or above relative equal highs. That's liquidity. Okay. If you have already ran that liquidity, and you, for instance, let's make the argument that you're bearish. Okay. You're bearish on a market and you want to get short and you go into price data. Look at a weekly chart. It supports the idea you think it's going to go lower. Daily chart looks like it wants to go lower. You can clearly see where it would likely draw down to some old low or relative equal low. You want to look and see, has it gone into buy side recently on a daily chart, a weekly chart, or 4-hour chart? If it has and it's sharply moved away and started going lower, you are in right now a sell model. That means it's already started its movement. So someone that we're going to deem as smart money, someone short, their interest in this is for it to go to an opposing pool of liquidity, which is what? Sell side. So your first objective is to look for low hanging fruit. You want to go to you want to go to a 60-minute chart, find some relative equal low or single low that has not been traded to recently. There are sell stops resting below that. That's this market 101. You don't need to read books to know that. It's simple logic. If it moved up from there, chances are someone's holding a long position and their stop loss is right below that low. So the market's going to gravitate to that. If there's a large fair value gap, some kind of a buy side imbalance, sell side inefficiency that's below that, then you can view that as I'm taking a partial at that short-term 60-minute low, and I'm going to try to get into the high of that buy side imbalance, sell side inefficiency, the highest point, which would be like an institutional order for entry drill. If you were long or bullish, we're not doing that here. The example would be making the argument that we're looking for lower prices. You would look at the highest point of that buy side imbalance, sell side inefficiency, and then the equilibrium price point. That's how I would treat it. And then I would wait to see, does it want to move lower? I would use the consequent encroachment of that BISI to trade short if it was supporting the idea it wants to move lower. I would not be trying to trade the full closure of that buy side imbalance, sell side inefficiency. That separates me from the people that think they understand that, it's going to go there because gaps have to be filled. They don't have to do anything. Those gaps can stay there for a long time. And they